My name is Ben Lofthouse, and I have been at Janus Henderson for about 15 years, and we launched the Henderson International Income Trust in 2011 to specifically offer UK-based investors a vehicle to diversify your equity income streams. This presentation will touch on what HINT is, what we look for in terms of stocks, some content on dividends. It's been very topical over the last 18 months around dividends and their sustainability, and then finally just where we're positioned. In terms of what we try to provide investors as an investment vehicle is a high and rising level of dividends. What does that mean? We aim to offer a yield that is similar to the UK market and long-term capital appreciation. So the aim there is that you don't have to give up income to go overseas. We are one of the very few global funds that are completely ex-UK. That may not sound particularly relevant, but when it comes to income, I will show that there is a relevance of that. And the board is very committed to an attractive progressive dividend. Investment trusts have some tools that they can offer which allow them to smooth dividends over time in a way perhaps that other investment vehicles like open-ended funds don't, and HINT has used those over time to help deliver a smooth income to investors, which I will touch on in this presentation. In terms of what we look for, if you think of us, I think of us as dividend-seeking, valuation-driven investors. We look for companies that generate free cash flow after investments, so not just free cash flow before they've invested, but they have some spare cash, maybe for deleveraging, paying dividends, and ultimately for investing in their businesses. So that box of dividend sustainability is very much about businesses that will survive the long term, and we look for businesses that are undervalued. This doesn't mean they're just cheap, because not all cheap businesses are necessarily undervalued, but they are businesses that offer returns that we think the market is underappreciating, either the duration of their return, how long they will be around for, or perhaps the growth is underestimated. And then we look to be paid to wait whilst that undervalued opportunity is realized. In terms of the results for HINT, since launch in 2011, it would have turned £10,000 into just over £23,000, which is almost a 10% return per year. It has not been a smooth period, I have to say. During that period, we've had Arab Springs, we've had now the coronavirus, we've had various trade wars, and I think one of the key things we found is, being global, there's always something going on, but there's always opportunities, and there've always been ways perhaps to kind of navigate through some of the difficulties. In terms of inflation over this period has averaged about 1.8%, and the dividend growth has been good over the period. So again, grown well above inflation, which is one of the things we try to offer investors. In terms of this idea of ex-UK, I think this is an interesting slide for people. When we launched, so what this shows is the top 10 dividend paying stocks as a percentage of total dividends paid in the UK. So you can see the FTSE is the dark line, and just around 65% of dividends come from 10 stocks. And those stocks are on the right hand side. So in the last year, you've had Rio Tinto and BHP so far providing almost 20% of the income this year. Quite a lot coming from tobacco, quite a lot coming from oil. I think when we launched the fund in 2011, it was also quite a concentrated list, and we thought it would become less concentrated over time. But what we've found is that different companies come and go. So whether in the last year, the financials, many of the banks weren't able to pay their dividends. A few years before that, many of the miners weren't able to pay their dividends. People often ask me, well, isn't it the same if you go overseas? And actually, you can see there, these big stocks, the percentage of global dividends paid is much lower actually. So they don't influence the global system nearly as much as they do the UK system. And when it comes to Henderson International Income Trust, we have about just over a third of our dividends coming from the top 10. So, we do offer a diversification of income, and that has been important over the last decade. When we kind of look over the last decade, the squiggly lines on the right-hand side here are a study that we produce every year, and what they show is a dividend growth of the largest companies in the world, the top 1,200 companies in the world. And so you can see there actually, there's been a really big difference between how different regions' dividend growth has transpired over this period. So you can see North America is the kind of maroon line, and that's been pretty consistent actually, so growing at almost 10% a year over the period. You can see, unfortunately, down at the bottom, the kind of the purple line, the UK there and Europe were particularly hard hit by the pandemic crisis. So we can see here the dividend growth in 2020 ranged from -40% in the UK to +2.6%. I'm very pleased to say the UK, in our latest report, which isn't quite published yet, is growing quickly. But you can see there was an enormous divergence between how different corporate cultures and different companies reacted to it. When you look at this, one of the key things is concentration. So areas like Europe and the UK had a large number of financial institutions, and the regulators in many of those countries said that banks, for example, weren't allowed to pay dividends. When you look at areas like North America and Japan, the regulators there actually didn't stop the banks from paying the dividends. So you saw big differences like that. Regions that had more concentration of cyclical companies, such as commodities, also saw more cyclicality. And so it was possible to diversify your dividends quite a lot by being in different parts of the world, which I think is not always obvious to people in different regions. Australia was another region, for example, that was very hard hit by dividend cuts. And I do feel that this is one of the reasons why people are a little bit nervous about coming back to equities for income, because they're not necessarily, so the last thing in their mind has been the dividend cuts in the last year. When we look at our experience, we were able to smooth the dividend over the period. For those that don't know, investment trusts can hold back revenue in good years to be able to pay out in other years, which is something perhaps open-ended funds can't do. And they're also able to distribute capital reserves of realized capital, which Hint has not had to do because the dividend has come through. But we did use this year about 5% of reserves to cover the dividend, and we have just increased the dividend by 20%. So the increased confidence that we're seeing in some of the dividend trends after seeing a year of a lot of volatility is allowing us to continue what is a 10-year trend of increasing dividends. In terms of stocks that have high yields, there's a lot of detail here. I won't go through each stock, but what I think I wanted to show people is where the income is coming from if it's not coming from big oil and big tobacco stocks. And you can see here it comes across a wide range. So something like Tele2 is a Scandinavian telecommunications company. So it's a good dividend payer. It's a very stable market. So like AXA, a big insurer, very diversified. It's got a high yield, but it pays out about 50% of its earnings. And it's just actually reported this week, and it had good earnings, and it's also doing a buyback. So I think one of the things that's interesting is that these yields are still very high, given that interest rates are still very low, and the range of companies that and regions they go across. So we've got some Korean technology there in terms of Samsung. We've got some Taiwanese technology there in terms of Quanta, and these companies genuinely are have ambitions for growth, and coming through the crisis are looking to grow from here. So just a reminder, really, our income is very diversified, and really just I think what's quite interesting is over the last 20 years, we've seen dividend cultures emerging from different economies that didn't used to be. So something like Samsung did not used to pay any dividends, and we're seeing areas of the world, despite what we've seen in the last year with dividend cuts, increasingly adopting dividend-paying cultures, which is very good for investors to be able to diversify where they get their income from. In terms of particular stocks, what I think I wanted to highlight was just that it's very varied where we're seeing dividend growth coming from. So a company like AbbVie, which is in the healthcare sector, a pharmaceutical company, has recently increased its dividend by around 9%. That's a company that hasn't been particularly affected by the COVID crisis in the same way that a leisure company might have been, but where there have been people worried about potentially drug price regulation in the US and some of these things. So that's these companies are very attractively valued in our opinion. But again, we are still seeing growth from them. Companies maybe that are more obvious that would be growing would be companies like Texas Instruments, which is a semiconductor company. So it produces the semiconductor chips that goes into increasingly almost everything we use, whether it be computers, phones, increasingly cars, ever increasing range of products use those. And again, what we've seen in this crisis particularly versus previous crises is the technology sector was previously very cyclical, and we've seen a lot more structural growth in this and actual shortages of semiconductors because of some of the demand. Manulife is a Canadian insurer. Again, just the point here is to illustrate again, not all companies had to cut their dividends in the financial sector. This was a company that carried on paying its dividend through the last year and actually carried on increasing that dividend. In terms of Henderson International Income Trust, just to give you a little bit of color on how we organize the trust, we have sort of sleeves of portfolios. So you can see here on the far right-hand side, we're limited to 50% in any one region. So the aim is to keep you diversified whilst giving you good exposure across different regions. You can see here, all of the regions have interesting yield. People often think that the US has got no yield in it, or Asia Pacific has got no yield in it, but the average yields, are not out of line. These are trailing yields with the overall yield of the trust. And for those who are interested in valuations, you can see the price to earnings ratio here, kind of one of the metrics of valuations. Again, is in line with history for us, so it's not particularly stretched. People do look at some parts of the market and say they're expensive, but other parts, are very cheap, such as Europe and Asia Pacific. One of the things that's characterized the last decade for people has been the fact that things like some parts of the market have significantly performed strongly. Areas like technology, other parts of the market have lagged. I think for us, we're seeing opportunities across a wide spectrum. You can see here in terms of positioning, we've got significant weights to financials, information technology I mentioned, healthcare, but also consumer staples and communication services there. So quite a wide range of things. And again, in terms of complementing a UK portfolio, we actually don't have very much at the moment in energy. We don't have very much in somewhere like materials. We have no tobacco stocks, actually. So it complements with a UK income portfolio well. Conscious of time here, I want to give you time for questions. One of the things I'll just dwell on perhaps is, let me just go to this slide. I think it's something that's written about a lot in financial press, is this relationship between growth stocks and value stocks. You can see here, this is very crudely the MSCI World Value versus MSCI World Growth Index. Value outperformed for a significant period from 2000 through to 2006, and then has had a tougher period since then, underperforming by a significant amount over the last few years. I think one of the questions people ask is, what will cause this to change? I think we would say, well, we're not we would not say that this is necessarily will suddenly change. We have a broad range of stocks in the portfolio. Our biggest holding is Microsoft, which is very much in the growth camp. It started off for us in the value camp. People didn't used to like it, particularly when it had bought Nokia's phone business, but it has evolved over time and it's changed from being a value stock 7 or 8 years ago to now a growth stock. I think what we're looking for is those companies that can change. So companies within the value area that can change. And for us, there are lots of trends at the moment in the markets in different areas like corporate change, electrification. We just had COP26. There's a lot of money that's going to be spent reducing our carbon intensity. Healthcare is something after this last crisis that has been highlighted. And so again, the idea, again, the message here is, we've spoken about dividend growth is coming through. Our dividend has been more sustainable than people think when you look across a wide range of companies. I think just finally, I'd say, we're not looking necessarily just to say things change and trends in markets change, but we do feel that the current market situation leaves lots of companies where their value is underappreciated. So it's quite an exciting time for us. And I'll stop there and allow any questions. So thank you very much for your time.
Okay, thank you very much for the presentation. So we're just going to dive straight in for questions. And we've had a few questions asking about currency risk and impact of currency changes.
Yep.
And I'll put two questions together. The first is a more broad. Can you talk to how currency changes affect the portfolio and the income? And a specific question, how much of the total return over the last 10 years is due to the depreciation of the pound versus other major currencies?
Yep, two good questions actually. So in terms of currency, the main way that we protect against currency is diversification. Can you see me? Do you want to get rid of this screen, or shall I leave the screen on?
It's up to you. We can, if you want, you might want to go back to a slide. So leave the presentation up in case you need
okay.
to
What I'd say is over time, the currency, is diversified by the fact that we have things in dollars, things in Australian dollars, Swiss francs. So we've tended to find that normally things don't go up uniformly with sterling, against sterling, or with sterling. The one exception to that would be with Brexit. So we did get a benefit in the short term from Brexit, because obviously we have got no sterling assets whatsoever. But then some of that has unwound over time with other currencies. In more recent times, sterling over the last year has appreciated against some other currencies. So I would say I don't have an exact figure for how much of the appreciation is currency, but over the whole period of 10 years, we've had periods where sterling has been stronger and weaker against lots of the different currencies that we have. In terms of the revenues, they get translated almost straight away into sterling, and so there's not a long period of translation risk. We do, to help with the currency, we have taken out borrowing in euros, so we have about 8% of the value of the fund where we've borrowed in euros to help, which we did when the euro was very cheap against sterling, to try and help hedge if the euro falls.
Okay. Questions about portfolio turnover. Could you talk to the subject of portfolio turnover? What's it like in the trust? And specifically, have there been any companies that you've added or sold recently?
Yep. In terms of portfolio turnover, it's generally been around 25 to 35%. In the last year, we did see a higher turnover. We did see opportunities present themselves in 2020 to invest, and particularly into some Asian technology stocks. So Samsung and TSMC here we added to quite significantly, and some other areas of Asia, which got very cheap last year. In terms of things that we've been doing over the last 6 months, we've been looking for companies where perhaps they're selling off, and the growth short term there's a concern, and people have been are overestimating some of those impacts. So we have bought some financial areas. So something like a Citigroup is a company that we've bought in the last 7 or 8 months. We have added into a company like Volvo down in the bottom left there. What do we find interesting about it? Well, actually, they do have hydrogen fuel cells, hydrogen fuel cell trucks, and electric trucks, and electric buses. So again, they will see demand for those picking up as we transition away from some other areas of combustion engines, and they may well see a pickup in demand for those as a result of companies and countries and cities trying to decarbonize. So it's a company that's been around for a long time. It's an industry that's quite concentrated. It's got a strong balance sheet, strong enough to be paying an attractive yield, and it's also well invested to be invested for the electric transition. So those are some companies that we've added to on this page recently. So and then companies that we've reduced exposure to, some areas of insurance. And so we did buy into insurance last year when we felt it was people overestimating the impact of COVID. We've actually reduced some of that exposure more recently as that's recovered.
Okay, you mentioned electric vehicles there. Where do you see future opportunities coming from?
Yeah, it's very interesting actually. So the electrification kind of process for uses a lot of different technologies. So you get companies like Tesla, which is not our kind of stock. It doesn't pay a yield, different valuation criteria. But actually, a company like LG Chem mentioned there is part of a bigger company called LG Corp, and they are producing the electric batteries for GM's car, the Ultima batteries. We own Panasonic, which actually contributes a lot of the technology to Tesla batteries. So again, it's a conglomerate. It's got different things in there. It's got appliance. It's got aerospace, many things again which are recovering, but also it has battery technology in there. And then companies like ABB are companies. It's a Swiss company. It not only does it do kind of process automation, so for industrial plants, but it is also involved in kind of electrification. And so again, when you go to charge a car, you may see parts of ABB technology in the charging networks, etc. And then finally, something like Daimler, is just about to launch the first electric S-Class. So again, we've seen a company like Mercedes-Benz pivot significantly over the last 2 years, changing from being focused very much on combustion engines to setting out quite ambitious objectives to move more of its portfolio to electric cars. So it's quite wide actually, trends like the electric car, and interestingly, they use a lot more things like semiconductors. So in Taiwan Semiconductor there and Samsung both make semiconductors, and we're seeing widespread shortages. I think have been in the headlines. It's very hard to find cheap second-hand cars at the moment because prices have gone up because there's a shortage of the semiconductors. So electric cars and self-driving cars and some of the autonomous features that we have in cars more and more consume a lot more technology than they ever have done. So again, the wider industrial base is seeing a growth benefit from some of these kind of features and changes in society that should make the growth rate quicker than it has been for the previous 10 years.
And next up, does the trust have a management performance incentive fee? And if so, could you give us details, please?
No, we don't have a performance fee.
Very good. Next one. Are there any plans to increase the AUM of the trust through merger with / purchase of other similar trusts to reduce fees? I think there's been trust consolidation has been a bit of a theme in some sectors, hasn't it?
Yeah, the trust is just over £300 million. We started at £41 million. We have done quite a lot of consolidation so far, so we are open to those opportunities as they arise, and we have reduced the fee as we've gone along. So the the ongoing charge was well above 1% when we started, and has fallen since then through consolidation. So when opportunities present themselves, yes, we are open to that. They are sometimes few and far between.
And I think we've got time for one last question. Do you feel the US market is overvalued and likely to pull back?
I feel that parts of the US market are overvalued, but I think that when I go back to this chart, it's a bit like this. So the cheapest stocks in the United States are as cheap as and as lowly valued as any other companies elsewhere. So auto manufacturers and insurance companies perhaps are on low valuations, and then there are parts of the market that are pricing a lot more expectation. Some areas of the software and areas like the SPACs, some more thematic areas. So I do feel the US has a range. I think as a market, it has a bigger percentage of what we know are called growth stocks, and so it has more of its market cap as expensive, but there are still a lot of stocks there that are interesting and market leaders in their field and attractive. So yeah, I don't feel worried about the stocks we necessarily own, but I can see that parts of the market are more expensive.
Lovely. Ben, thank you very much indeed for joining us.
Thank you very much for your time.